Welcome to TheoTRADE. This is Don Kaufman, June 14th, 2024. Just about 15 minutes to go to the cash close here on this Friday afternoon. S&P futures right now grinding right on the upper edge of the expected move. Of no surprise, once again, grinding right to a level that we called early on in the week. But I got to tell you, it's not about the grind to the upside. The market is just a story of big tech versus the S&P 500. People, the divergence continues. We're going to explain that and much more here, of course, on this weekend's update. All right, let's come to some of the live trade right now. So on this Friday afternoon, what are the markets doing? Just grinding. And when I was talking about grinding, on the Wednesday night video, I talked about the upper edge of the SPX expected move, what I often term the mother of all products. So what did we do on Monday? Absolutely nothing. On Tuesday, maybe a little bit of a grind to the upside on Tuesday, but coming into Wednesday, we had CPI, just leave it right there. Forget about even the Fed happened, right? CPI, we immediately jumped where? Right to the upper edge of the expected move. And if you listen to Wednesday night's video, I was saying the entire remainder of the week, all we're going to do is kind of ebb and flow right on the upper edge of the expected move. Ironically enough, said the exact same thing last week. And if you look at last week, here's Monday, here's Tuesday, Wednesday, we jumped to the edge of the expected move. And what did we did? Just, grinding right on it. And that's it. I mean, that's the marketplace right now. You can say it's a blistering move to the upside. But the interesting, and I think, twist to that is the marketplace is doing, if you will, exactly what you would expect. This line over here, which we draw every Friday afternoon, that's the happy place. That's where risk goes to die. And that line, so precise. This one was $75.20. And we'll talk about the expected move, of course, for this next week of trade here right at the end of this video. Nevertheless, okay, the expected move, as I said, we're doing exactly what we anticipated to do. You got to look at this, how uncanny it is. This is the second week in a row I was talking about the upper edge of the expected move. This number here is 54.22. We're trading 54.24 in change, pulling back towards the upper edge of the expected move. You realize it's a $5,422 product, and we're going to tag, okay, within what? A few pennies of the happy place of the marketplace, and that's some efficiency right there. And that is of critical importance. Now, the bigger story, though, and here's really what I want to get into, is it's a market that's just wildly divergent. We can look at the S&P. In fact, we can look at the spiders. Let's jump over to the spiders. The spiders, it looks like a one-way ticket, if you will, to the upside. But, the truth be told, there's just a lot more going on in this marketplace. As I keep saying, and I've covered this, even last weekend and, even on Wednesday, the divergences in the marketplace continue to grow. And one of the first things I wanted to explain here is what those actually look like. And when I say they continue to grow, let me be incredibly specific. So as we looked at the SPX, on a weekly basis, and what these lines represent is just that, a weekly basis. Like, what's the market supposed to do this week? Well, this week it's supposed to move 70, some odd dollars, and it hits it. And last week it was supposed to move 60 some odd dollars, and it hits it, right? So it's doing what it's expected to do. But if you look around outside of the SPX, let's start. And again, I have a full rundown of different products. If you look at again, a full rundown of the products I have over here, many of them are like sector ETFs, but I'm going to start with major indices. The Russell, it's a wild move, right? Some heavy volatility. And now I'm going to apply what I term auto expected moves. Okay. What's the Russell doing? Ironically, the Russell had exploded to the upside, okay? And that was on CPI, the Fed, and then came crashing right back down to where? The lower edge of its expected move. So, all right, the Russell's lower. Great. Newsflash, you're like, I don't trade the Russell. It doesn't matter. I got it. Okay. Let's move over for a second to Dow. all right, the DJI. In this case, I'm looking at the Dow in terms of its futures contracts. Interestingly and ironically enough, the Dow is also sitting just about the lower edge of its expected move. You're like, oh, okay, so great, man. You're 2 for 2 in products I don't trade. I got it. Now we're going to pull up the energy sector, XLE, right? XLE. This thing's getting absolutely hammered in here, right? So it's the energy sector. This one actually cracked outside the expected move. Now things are going to get more interesting. Now we're going to pull up the financials. The financials cracked outside of their expected move. That's the XLF. Now we're actually going to pull up XLP. Now we're starting to rotate through some bigger sectors in here. Now the XLP, if you're unfamiliar with some of these products over here, this is consumer staples. Okay, and there's a lot of different, this one's about halfway home to the lower edge of the expected move. So far, everything we've looked at, an IWM lower edge, Dow lower edge, XLE is outside, okay, XLF is outside, you know, that expected move there. XLP is lower. Okay, we're going to look at XLU, which is utilities. And I know that utilities, they're little. They're actually about unchanged. I'll give you that. That's one of the better ones in here. Now let's come to XLV, which of course is healthcare. Healthcare's got some size to it. Healthcare is about halfway home to the lower edge of the expected move. Okay, then we're going to look at something crazy here like XLI. I never look at this stuff, but I'm trying to make a point. Lower edge of expected move. By the way, XLI is the industrial sector. That doesn't happen anymore, you know, and it just goes on and on and on. I think I even pulled up, like the other day, I was pulling up like XLB. I didn't even have that in the list. Materials, okay, in the materials sector, that's actually halfway head, you know, home to the edge of the expected move. XLI, then we look at XLY. Now, XLY actually includes like Tesla and so forth. Ah, I finally found one. That actually includes Tesla and Amazon. It's just north of unchanged. That's one of the few that is actually positive, okay? And last but not least in here, and this is one I never pull up too, is XKTL. And XTL, you're like, what is XTL? You never heard of that one, huh? It's telecom, okay? And it's actually lower edge of the expected move. Point being, look, all I have to do then, you're like, so what is up? You know, stuff like SMH, okay? SMH exploding to the upside over here. If you take a look at auto expected moves outside the upper edge of the expected move, okay? Semiconductors, chips, that's the place to effectively be. What I'm showing you though in here, okay, is that, look, it's not just one or two sectors. It's everything. It's everything. It really is a story of, when I start talking about big tech, okay, I'm talking much more now. It's even, you know, it's NVIDIA. So if we want to take a look at NVIDIA, first of all, I'm going to be the first one to say I am surprised it's held up this well throughout the course of the week. Okay, in fact, I'm a little bit shocked because last weekend I didn't think it'd be able to sustain it, and I told you exactly why. The option volume in NVIDIA would have to be staggeringly large to maintain, okay, what has been a wild gamma squeeze. And you want to see massive, okay, take a look at this. NVIDIA is doing today just shy of 8 million option contracts. Markets close in about 5 minutes. We're going to do just shy of 8 million option contracts in NVIDIA. And you go, oh, okay, golf clap, what does that mean? Now you're starting to have to compare it to a product like the Spiders. The Spiders, in terms of volume, are unequivocally the most prolific product in the marketplace. Spiders today are actually going to do less contract size. Now, the Spiders are also a $540 product. Yeah, the Spiders are trading more notional value, but they're still doing less contracts than NVIDIA. So I'm eating my own words on there on NVIDIA. It has been able to sustain it at this particular point in time. But the divergence, it just continues to grow. And when I start talking about divergence, you know, it was a while ago. I remember I built a style. Okay, when I'm over here on Thinkorswim, there's different styles you can build. And one of the ones I wanted to show you that I thought was pretty interesting, it's QQQ Spiders IWM. So let's actually load the Qs in here. Okay, this is just a simple comparison chart. And this is something that, yeah, kind of prefabricated in here. But what you're actually looking like at is just a year-to-date, okay, of the Qs. So I'm actually going to label them on the chart over here. It's a little easier to see. This is the QQQ up top, okay? That's your spider. And down below over here, headed south, is IWM. And I could actually build this with all the different sectors as well. No need though in this case. I wanted to show you that divergence. Now, I'm going to close up this left side bar. That's just year to date. And one of the most important things year to date, okay, when you're looking at a comparison chart, right, you have a singular, like a point, okay, where they diverge effectively from. And this is just year to date. But let's actually look at this, okay, on a little bit of a longer time scale. Let's actually look over the last 3 years. Over the last 3 years, again, diverging for the last 3 years, pretty phenomenal, where the Russell is still down 14%. So one of the arguments that's been going on lately is like, it's a bull market, it's not a bull market. Okay, depends obviously what marketplace you're looking at. When we're looking at right now is NASDAQ, Russell, and S&P 500. It is very different marketplaces. Now, one of the things though that I want you to understand about this, okay, these are wild, okay, historic divergences that you're effectively seeing right now. And tech, and it's just easy enough to say like, oh, tech has just taken over the entire marketplace. Yes, okay, but the divergences have grown to such epic proportions that at this point, I think you have to assume that we are in fact on borrowed time. And there's an excellent trade in here. We're going to go back now over 5 years. One of the things that I want to point out about wild divergences like we are presently seeing is that they always unequivocally end, okay, in heavy volatility. And that effectively means, now, does this NASDAQ here eventually have to converge upon the Russell? Absolutely not, okay? But as they continue to expand apart, they will, in fact, come back together to some degree. And in doing so, okay, those convergences are always met with extreme bouts of volatility. If you take a look back over here, right, as they started to diverge, right back here as I'm circling this is actually COVID, some of the COVID lows. Coming back in here, 2022 and 2022, obviously volatility picked up substantially. You can see the marketplace converging dramatically. And here we are in one of the biggest divergences, okay, in history, period, especially in this short a period of time. Now, we can even jump back to like some 15 years and you can see how epic, okay, some of that happens to be. And for those of you that have been around long enough to have traded even longer than that, go back 20 years in time, and you start to actually look, you start to zoom in over here, financial crisis and so forth, things get really, really wild. Again, the bottom line with this is how epic this is over the year, how epic this has actually been, that it really is a tale of two totally different marketplaces. And as I've reiterated, okay, especially when it comes to NVIDIA, and speaking of NVIDIA, NVIDIA right here at the close, okay, is basically neck and neck with the largest market cap out there. So NVIDIA is 3.24 trillion, okay, and you're actually seeing, there's the closing bell. You're actually seeing now the market cap in Apple, 3.258 trillion, and of course Microsoft at 3.289. So we're neck and neck. We basically have what amounts to 3 products now that control $10 trillion. That's right, 3 products that control $10 trillion of market capitalization. So we'll finish in the S&Ps massively unchanged into that last couple of seconds of trade over there. Nevertheless, divergence, you got to keep this in mind, always ends in volatility. And if you're looking at those divergences and you're thinking like, what's the trade? It's one of the things we're going to be talking about extensively this next week here at TheoTRADE, is how to effectively, okay, position yourself for what will be the convergence without sustaining, okay, risk out there. Now, with that, as I was saying, NVIDIA, okay, taking a look back at NVIDIA and going back to some of the order flow in there. So as I said, it's good for just about 8 million contracts, and it's exactly what it did. It is absolutely blistering volume. And as I said, that's not going to be able to sustain itself, but there hasn't been even a flinch of a pullback at this point in NVIDIA. It's nowhere to be seen, okay? That's going to be critically important. Now, I'm going to push that aside. We'll talk much more about the divergences, of course, this coming week, spend a little bit of time in how to actually execute upon that particular trade idea. Now, there's one thing I want to remind everybody of as well, and this really, it comes to mind because this morning, okay, in the S&Ps, and again, this is the in the S&Ps, this morning, the S&Ps were actually down quite a bit. They were down about 40 handles. But just a brief reminder, okay, that we're now dealing with a $5,400 product, that a 1% move is basically 54 points. So to even see a 50-point move inside of the ES is nominal at this point. So, you know, you have to look at a given year. In any given year, okay, how many big moves do you get in a given year? And one thing I want to make very, very apparent, okay, because again, people kind of get lost in points and percentage moves, but it works just like any other distribution curve. Like how many days do we have that we move within 1%? Okay, how many days do we have we move within 2%? Okay, it's supposed to be a percent. How many days, you know, throughout the course of a year do we even move 3%? Well, with a 3% move inside of the S&P 500 right now, you have to recognize you're looking between, you know, 160 and 170 S&P point move. So one of the things I want to remind everybody of, just again, you got to focus once in a while on bigger picture over here. The moves we're seeing day to day, you know, it was a blistering move to the upside after the CPI. Yeah, so we jumped up a little bit after CPI, like some 50 handles. Wasn't even but a 1% move. Okay. And sometimes you have to back away from the marketplace. Somebody has to give you a perspective on percentage gain and percentage loss, because in any given year, as I said, you're going to have X number of days that are inside a 1% move and X number of days that are inside a 2% move. And you are going to get, okay, considerable number of days that are even 3% moves. So be aware of it, because we get lost in what looks like relatively light volatility. Speaking of volatility, let's jump over, okay, to SKEW. One of the things that's also very apparent is that there are traders, okay, that are absolutely starting to put on defensive positions. SKEW alone is indicative of that. And what SKEW basically is it's just way out of the money options. It's like SPX 30-day way out of the money options. Okay, what SKEW would be indicative of, there's a lot of puts being purchased, so there's demand for out of the money puts. That's also, you know, construed as hedging activity. A 162 SKEW, which was yesterday's closing SKEW, is indicative, of course, of some hedging activity. Somebody's buying, you know, huge numbers of out of the money puts, or they're using that either a hedge or they're trying to take a downside position, and to finance that position, they're often selling calls. In conjunction with that, though, we've actually seen some movement in VVIX. This is the volatility of the volatility index. Doesn't look like much till you kind of zoom in. It's a pretty mellow trading session. Nothing going on today. S&P is massively unchanged. This actually picked up quite a bit, right? So VVIX, the volatility index, there's hedging going on there. Okay, VIX itself, and I think VIX is a ancient instrument, but even VIX picked its head up today in the midst of what was a fairly light day. The other, though, real consideration, I'm not really considering VIX. The other consideration, though, is the dollar. Okay, and all of a sudden there is quite the consideration and rush, if you will, into the US dollar. This is something going to be well worth watching in the days to come. So we are seeing some rumblings, if you will, of volatility ahead. Now, with those rumblings, if you will, of volatility ahead, all we're really seeing at this point is hedging activity. Just because there's hedging activity, it definitely implies, yes, some people are taking, you know, adverse maneuvers to protect themselves. You know, they're going out there and there's some hedging strategies being used. That's what I would assume was SKEW, VVIX, dollar. Period. I'll leave it at that. I mean, nobody sees like, oh, it's coming, there's risk. But what we do see right now, and again, we see it constantly, the divergences are huge. I mean, Apple, this is phenomenal size in here, phenomenal size. And we're talking about, you know, NVIDIA that traded some 8 million contracts. Look at Apple, still did under 2 million contracts. You got Tesla. Tesla's been in play throughout the course of this week. Tesla, good for 2.6 million contracts. Everything pales in comparison, okay? And that's why I said, I believe that this divergence is likely, the situation is kind of coming to a head and quickly. All right, this next week of trade, we're coming into another week of trade. People, look, this one's going to be a little bit funky, right? So we have June 19th in this next week of trade. And if you take a quick glance with me here in the SPX, the mother of all products, you'll actually see, all right, so you got Monday, you got Tuesday. Markets are closed on Wednesday for June 19th. They're open Thursday. Okay, then there's an AM settlement and a PM settlement. Why? Because we are coming in to the triple witch. The triple witch returns this next week. Effectively what that means, okay, is you have futures. Yeah, futures markets, they're actually going to roll over. They're going to expire. You have options, obviously, expiration, equity expiration. It's a party, people. Anyway, the triple witch will return. And what's strange about it is we have one less day to roll inside of many of the products, simply because, again, we do have a holiday that is going to fall next Wednesday, right smack in the middle of the week. So the only time you have to roll is going to be like Monday, Tuesday next week. We're closed on Wednesday, Thursday, but it's sketchy to wait to roll that last day. So things are going to get a little crazy as the triple witch returns. Might be one of the reasons the SKEW and the VVIX have actually picked up. All right. Last but not least, we do each and every weekend update here to talk briefly again about the SPX. So we're coming off, okay, SPX having roughly a $75 move. And I just want to be able to quantify, markets are now closed. All right, here we are. We're going to zoom into this and just take a quick glance. Well, we were supposed to be here at what? 54.22. We ended up closing here at 54.31. So look, when it's within, 5-10 points, okay, it's a near miss. The exact same thing happened last week, like right in the last couple of seconds. That's it. We basically closed on the upper edge of the expected move. Now, what is important, though, is not what just happened, but what's about to happen. And next week, 7 days out, we're looking at about a $61, $62 expected move. Now, people, this is important. This number, it's not yet set, okay? The number and the close of the SPX options doesn't happen until 15 minutes after the cash close, but we're looking somewhere around plus or minus about a $61 move. Now, we just came off of a week that had a $75 move. We had a $75 move, but we also had CPI, we had Fed, do a little dance, make a little love. This is also, okay, a 4-day trading week with a $61 expected move. So still quite a bit of volatility packed in for this next week of trade. Look, okay, whole lot of the same of this week, but it all literally in this next week of trade, it just comes down to the story, okay, of big tech versus the S&P 500. One last thing I'll leave you with, advanced decline line. Throughout the course of today's trading session, most of the day, the advanced decline line has been decisively negative. That's something to look for next week. As I said, the divergence just continues to grow. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.